G'day, you were Nick Reinberger here at ABC Illawarra. The holiday is over. The honeymoon has ended. I'm talking about your mortgage. Major banks are going to stop accepting COVID-19 mortgage holiday applications as major lenders contact tens of thousands of customers who are yet to start repaying their loans, according to a new story in the Sydney Morning Herald. Is that something you have done? Have you applied for a mortgage break while perhaps you couldn't work or you were on JobKeeper or JobSeeker? What are the implications for that? What will happen when you get back to normal payments? Or should you be actually raising your payments considering the interest rates do not stop? Martin North is our local financial analyst and he joins us now here at ABC Illawarra. G'day, Martin. How are you going?
Pretty good, Nick. You?
I'm not too bad. When you come back to regular payments and you're either forced to or you offer to go back to it, what is the implication for these holidays? Are you going to be well behind?
Well, it's certainly the case that although you didn't need to continue to make payments either on interest or principal, the interest was continuing to tick up. So what it means is that the balance on that mortgage, be it a small business loan or a mortgage on a property, would have grown a little over the time when you weren't making repayments. And generally, the banks are extending the life of the loan, or in some cases, they're suggesting that people should be making bigger repayments now to adjust for that change. So I guess it depends on individual circumstances as to whether it makes sense to increase your payments or not. And by the way, there are still, around 100,000 customers who are still on these holiday repayment programs at the moment. So not everybody is off it yet.
Having said that, though, with quite low interest rates, if you're able to negotiate a reasonably low interest rate, are you really going to be penalised that much for having a holiday?
No, actually not too much, but actually the truth is that most people are probably paying more than they should in their mortgage anyway, because there's this sort of what I call the apathy tax. In other words, rates have come down a long way, but many people never actually bothered to switch to a lower rate. So actually you could probably save more by switching rather than actually staying on the previous mortgage. So there's not a huge amount, but it does tick up, and of course it's interest on interest as it rolls over the month.
Yeah, especially if you've got $500,000 on it, though. So if you said that many banks were extending the life of the loan, so if you had a 25-year loan, you had maybe 15 years to go on it, the banks might have said, okay, we'll give you another 20. Is that how that might have worked?
Well, if, for example, you had an 8-month repayment holiday or a 10-month, which is sort of average, I guess, then maybe the duration of your loan would now be extended by a further 10 months. So it's basically just extending it by the amount of the holiday.
Oh, okay, so by whatever the holiday was, they'll just put it. Does that mean your payments would be broadly the same?
Yeah, well, I think that's the idea. So you just continue to make the same amount of repayments, but for longer. And of course, that means you'd be paying a little more interest. So I guess in net terms, the banks a slight win. I'll also make the point that in some cases, banks have actually come back and said, look, we know your financial situation is not as it was, so what about a more substantial restructure? And that could be, for example, a significant extension of the loan period, or it could even moving the interest from interest and principal to just interest-only loans, which would reduce the repayments. So banks are being relatively flexible in some circumstances if people are still in a situation where their income profile is rather different. Although we are seeing a few stories now coming out where the banks have said, no, we want you to make a capital repayment to pay down the amount that you should have been paying, the $20,000 or $30,000 that you should have been paying. Now, that's a worry if that is true. It's not widespread, but I hope we don't see that too much.
Okay, that's interesting. So back to a previous point of yours, which is that there's this kind of apathy tax. People, it's a hassle to change lenders and to pick up the phone to your bank manager and say, can you do any better? But this point at which you're back to work and the mortgage holiday is over sounds like a good opportunity to do that, to try and restructure it completely so interest rate might have a 1 in front of it, for instance. Would that be right?
Well, you can get some remarkably low rates, particularly if you have a little bit of equity in the property. You know, you're not at 95%, but sort of 80 or below. And I generally have the view that every year, you know, maybe around the time of the holidays, it's worth sitting down and saying, well, where am I? Have I really got the best rate that I can? Because frankly, a 1% drop in the mortgage rate is huge in terms of what it means in terms of what you don't pay back to the bank, because you don't need to, because the rates are low, right? So it is worth shopping around, and there are some very, very good deals out there. The banks are desperate at the moment to write new business, specifically for lower risk customers. So absolutely, good time now just to sort of shop around, and you can, you know, go on the online tools and see the various options that are there. It's not really that difficult, and the banks have now been required to make the loan switching process a whole lot easier than it used to be, because it used to be a real hassle. It's much easier now, so there really is no excuse for paying more than you need on your mortgage.
How low can you go? What are we talking about?
Well, you know, there are rates with a 1 in front of them. That's a little bit unusual, but, you know, if you've got a 3 or a 4 with a mortgage, then you're definitely paying too much. But it does depend on the individual circumstances, the size of the loan, the risk profile, et cetera, et cetera. So it's hard to give specific indicators, but generally it's worth just looking at the recent offers that are there, and they are remarkable. Because, of course, the banks are getting really low funding from the Reserve Bank, right? You know, the cash rate is close to zero now, and the Reserve Bank is throwing really cheap money at the banks to encourage them to lend, and that gives them capacity to lend at much lower rates than previously. So there is definitely an opportunity for people to shop around.
Interesting. All right, great to talk to you this morning. Thank you very much, Martin.
Good to talk to you.
That is Martin North, one of our local financial analysts here at ABC Illawarra Mornings. Great to have you with us on the morning show.